best child education plan in India is what every parent is looking for. But why do so many still get trapped in law written policy that cannot keep up with college tuition inflation? So hi, I'm Mariam and you are watching PolicyHub. And if you find our insurance video helpful, subscribe to the channel. And if you prefer to watch it in Hindi, you will find our Hindi channel link in the description. And this video will help you choose the best child education plan in India by comparing traditional child insurance plans, government schemes and mutual fund SIPs to build an education fund that keeps pace with inflation. But the real concern is that will the plan you choose actually cover your child's future education costs? Because many parents get locked into low return policies only to discover later that the maturity amount may not be enough to fund their child's dream degree, and that potential shortfall becomes even more serious once education inflation enters the picture. While general inflation in India may remain around 5% to 6%, education cost can rise by approximately 10% to 12% annually. At this rate, a degree costing 20 lakh today could cost around 52 lakh in 10 years and between 84 lakhs and 1 crore in 15 years. So this means your investment must grow fast enough to keep pace with these rising costs. Otherwise, even years of disciplined saving may leave your child education fund short. And in a traditional child insurance policy, the internal rate of return is usually just 5% to 6%. If education costs grow at 11%, a 5% return guaranteed plan is technically guaranteeing that you lose purchasing power every year. And once we compare the actual numbers, the right approach becomes clear. The best child education plan does not necessarily have to be one traditional policy or ULIP, because more practical strategy is to keep insurance and investment separate. So use adequate term insurance to protect your child's education goal and build the required fund through two investment buckets. And the first bucket is that the government backed foundation. And this bucket provides stability to your education fund. For a daughter, Sukanya Samriddhi Yojana currently offers 8.2% government-backed interest with tax benefits subject to applicable rules. For any child, PPF can be considered as a long-term option and currently offers 7.1% depending on your timeline and financial situation. And around 25% to 30% of the education fund may be allocated here. However, both schemes have tenure and withdrawal conditions. So make sure they match the year in which you will need the money. And most parents realize they were sold the wrong education plan when their child is in class 12, when it is already too late to fix the deficit. So don't let high agent commission cost your child their dream college. Click the link given in the description to get a 100% unbiased personalized child education roadmap tailored for your exact budget. And bucket number 2 is that the growth engine, because a stable investment may protect your money, but it may not be enough to keep pace with rising education costs. And for a goal that is 10 to 15 years away, monthly SIP in diversified equity mutual funds such as Nifty 50 index fund or flexi cap funds can provide long-term growth potential. And parents comfortable with higher risk may also consider limited exposure to mid-cap funds. So depending on your risk tolerance, around 60% to 70% may be allocated to this growth bucket. And equity mutual fund have historically delivered strong long-term returns, but returns of 12% to 14% should be treated as the planning assumptions, not a guarantee. Now you might ask, what happens if I am not around to continue the SIP? That is where traditional agents scare you into buying expensive child plans. So here is the superior alternative. So instead of paying 1 lakh rupees annually for a child plan with a teeny 10 lakh cover, buy a pure term insurance policy of 1.5 to 2 crore for just 15 to 16,000 rupees a year, and attach a waiver of premium rider or structure the payout to clear all future educational expenses automatically. By doing this, your child receive 10 times higher life protection and you invest the remaining 85,000 rupees directly into equity mutual fund. So over 15 years, this difference create an extra 25 to 40 lakh rupees in wealth for your child. To put this into action right now, follow these 4 steps. Step number 1 is calculate your target year and target corpus. If your child is 3-year-old today, you have 15 years until college. So adjust current fees by 10% annual inflation. Step number 2, lock your base safety with SSY or PPF. Step number 3, start an automated monthly SIP in low cost index and diversified equity fund. Step number 4, ensure the breadwinner with adequate pure term insurance so the education corpus is 100% guaranteed no matter what. So that's how you can choose the best child plan for your kids. And need help planning your child's education fund? Contact our PolicyHub team, and if you found this video helpful, like, share and subscribe to our channel. See you in the next video. Until then, bye.